I'm James Eaton.
And I'm Matt Smiler.
Welcome to Katz Abosch's Executive Insight Series.
Today we're going to talk about rental properties. There are a lot of areas we could cover, but today we're going to review a few questions we often receive. How should I structure the operation? Who should manage it? What tax matters should I be aware of?
Let's first start by understanding possible legal structures. A common question we receive is, should I form an LLC? If you own rental property, one of the biggest advantages of a limited liability company, an LLC, is that it can help protect your personal assets by limiting your liability to only the property inside the LLC. This means that if, for instance, a person were hurt in your rental property and you were sued, you could lose your rental property but not your primary residence or your other personal assets. LLC statutes vary by state, so be sure to consult with a legal or tax advisor. Conversely, although many folks hold their real property assets in LLCs, they may not be the best holding vehicle for every small property owner. For small real estate investments, the trouble and cost of forming and maintaining an LLC may not be worth the protection from a theoretical threat of a lawsuit, particularly when affordable liability insurance is available.
Good information, James. Another question we get a lot is, should I hire a management company?
Well, again, that depends on your personal situation. If you don't want to be woken in the night to address a flooded basement, and if you don't know how to fix a broken window, then you should probably strongly consider hiring a management company. Another thing a management company may help with is marketing the property when it's vacant. All these are issues to be considered when determining whether to self-manage or engage a management company.
That's right, James. Another item for that list is to consider the location of your rental property or properties. You should ask yourself, does it make sense to drive out of your way to manage the property? Having a management company do that might save you a lot of back and forth. So for our final question, James, what are the tax matters that we should consider?
Well, one thing to consider is whether the owner materially participates in the management of the property and whether they are a real estate professional. Generally, a rental property is a passive activity, which means that annual losses for real estate are not tax deductible. This is the case unless the owner meets very specific rules to be a real estate professional. These rules include the owner spending greater than 50% of their time working in real estate, which specifically does not include time spent as an employee of another company. If the owner meets the real estate professional requirements, then they must also materially participate in the management of the property in a regular, continuous, and substantial way. This greatly limits your ability to deduct losses because passive losses can only be used to offset passive income. The flip side of the coin is that these losses may be available to offset taxable income in the year a rental property is sold. Also, sales of rental properties are taxed at lower tax rates than ordinary income such as wages and interest. These rules are complex, so it's really best to work with an advisor.
Thank you, James, and thank you for joining us today. Remember, financial planning is unique to each person and company. If you would like to discuss these issues or others, please don't hesitate to contact us.